On today's episode of Strategy Simplified, I talk about an organization that we don't often think about in the business world, the government. Well, scratch that. We think about the government, but not in a good way. In this situation, I'm actually thinking about the government not as a taxing organization, but as an organization that operates like a business with revenues and expenses. And therefore, it falls under the purview of Strategy Simplified. If this organization has bills to pay, how do they pay it, especially in a pandemic when they run a deficit? Let's find out. One of the amazing things about the framework of Strategy Simplified is that it thinks about whether an organization is a variable cost or a fixed cost organization, not whether the organization is a business, a government, or a nonprofit. And so today on this episode, I'm going to talk about something different, an entity that we haven't covered so far, and that's a state. The reason I started thinking about this is that I currently live and have loved living in California. I've lived here for 12 years. And one of the things that happened at the beginning of the pandemic was a statewide shutdown order. Our budget at the beginning of this year was projected to lead to a small surplus, but essentially a balanced budget. And with the deficits that led to massive unemployment claims and also taxation decreases that were so significant, we have at this point about a $54 billion deficit for the state. So it got me to thinking, using the Strategy Simplified framework, how could we think about the ways that you can pay back a state's deficit? If you were a business and you ran a deficit, if you had a loss, you'd have to think about ways to pay it back. Lending or borrowing is not one of those because that simply just moves it down the line and it adds interest expense. And so if we take borrowing off the table, which only manages short-term cash flows, it doesn't actually get you to where you need to go. How do you increase your revenues or decrease your expenses in order to balance a budget, to pay off a deficit, and to ensure that a state begins again to operate in the black? So I've broken it down to 5 ways, and then a 6th if the state is sovereign, if it also has a central bank that it can use. Way number 1, you can expand the tax base. What do I mean by that? You can have an influx of residents, or you can have those residents making more money if you have an income tax, or purchasing more things that they are paying tax on. So there are different forms of tax. There's personal income tax, there's business tax, there are taxes that are on the items that you have, there are transaction taxes in terms of real estate. And so expanding the tax base, expanding the number of people that are purchasing things and the number of people that are earning is one of the primary ways that you can do this. And you've seen success in this in a number of different places in the United States, states that are net population positive, that are attracting people in and that are therefore expanding their tax base. Second, you can raise the tax rate. So if all else fails on expanding the number of people who are paying taxes and the amount that they're buying and the amount that they're earning is not increasing, but you still have, let's say, $54 billion to pay back, well, you can raise the rate of tax. And California's governor actually did this as an emergency measure on businesses. But you can raise the rate of taxes on businesses. You can raise the rate of taxes on different items, for example, car transactions or car registration fees. You can raise the rate of taxes on real estate, the taxes that you pay per year, the taxes that you pay per transaction. So instead of just increasing the volume of all of those numbers or the base, the size of which you pay it on, you can actually just increase the rate. That's option number 2. Option number 3 is that you can expand what gets taxed. So if you're currently not taxing certain things, such as cell phone ownership, you could tax that. You could say everyone who owns a cell phone now owes the state $100 a year to have the right to use that cell phone. And so you can expand items that are currently not taxed into taxable categories. And those of us that are in California might be shocked to discover that some of the things that we pay taxes on already, like gas and gas taxes, are significantly lower or even zero in other places in the world. If you're enjoying learning about strategy and want to put it into action, one of the best ways to do that is by joining us on a future strategy sprint. Strategy Sprint is a 2-day training process, 1 day for skills and 1 day to plan with a team how to solve an actual case. Then we put you live with a client for an entire week with a coach that is a former McKinsey, Bain, or BCG staff member. Your coach will guide you through how to interact with the client, how to resolve data, and how to make great recommendations. Join us for the next strategy sprint by finding the link in the show notes and registering on our upcoming waitlist. We look forward to having you. Number 4, we could cut our spending. This is one of the most dramatic, more difficult things to do, and states are not built with incentives to cut their own spending, but it is probably in this situation one of the most important and valuable things that they will do. However, it will likely be in that order on their list. It will likely be number 4. Number 5 is that they can get bailouts from other places. I want to distinguish here that the bailout is not the same as a government lending organization or something that is offering debt to a state. So if California, as an example, or if another state that has a deficit takes out a debt line or a credit line, they still have to pay it back, and they also have to pay it back with interest. And so I'm talking about ways to decrease the deficit, not ways to simply pay for your expenditures in the short term. So government bailouts absolutely do that. So getting money from other places that are either through grants or through politics, through trades of some sort, through applications, through standard or non-standard channels, applying for government aid from a larger government body or even from international organizations is one of the options. Clearly, there can be some longer-term political consequences in doing that as well. And then finally, number 6, if you are a sovereign nation state, not like California, but like the United States or like Canada or like many other states that have their own central bank, the final thing that you can do is you can print money. You can print money, effectively devaluing your currency. And therefore, as you're collecting rates, especially in the short term, what you have to pay back will be worth less. What you are collecting will be progressively also over time worth less, but relatively will be worth more to pay back the deficit. And so if you do take out credit lines, for example, you can pay those back in the near term by printing money. These 6 ways are ways that states or other organizations that are government oriented can pay back their deficits. If you live in a state that has a deficit, I'd be interested to know what some of the things are that you're taxed on, what some of the things are that you are facing questions about related to COVID in terms of increases of taxes, and how your state is paying for the decisions that it's making. If you live in a sovereign nation state that has handled questions around payments related to unemployment and business closure in different ways, I'm in the process of collecting a massive body of data that looks at different state and government reactions based on the spending that they do and the revenue that they're bringing in related to COVID. Once you reach out to us at team@managementconsulted.com to provide information and stories from your side. And also, we would love for you to find more out about us on our website at managementconsulted.com.